think we should be all set. Theater's full, ready to go. So we've got quite a bit on the agenda here. So first off, thank you for joining us. I'm Brad Long, partner and deputy chief investment officer at Fiducian Advisors. And this is our market update and volatility call. I'm joined by my partner and devilishly handsome CIO, Matt Reits. We're going to do a couple of things here. First is we're going to do a bit of a tour of the capital markets, kind of where are we, and a little bit of how we got there. Then we're going to talk about our outlook. You know, what do we say coming into the year? What's different now? What are changing? And then some practical takeaways at the end. I would say our lawyers couldn't be here, but they asked us to show you this slide. And so having done that for a minimum amount of time, we'll jump straight in. A bit on housekeeping though, you can ask questions. We got a number of questions ahead of time. So thank you very much for posting those. You can put them in the queue. We'll try to get them addressed as we go through with regularly prepared comments. If we don't get to them, we'll try to get to them at the end. And if we finally don't get through that list, just give us a call. We'll address them on a one-off. But I would say, just setting the table here, 2022 has been a volatile market as an understatement. My colleague Oakley Duryea shared a stat with me this morning. In the typical year, the S&P usually has 8 days in which it's up or down in a single day by more than 2%. In 2022, even though it's May 19th, we've had almost 20 of those days. So we've certainly felt our full share of volatility, more than, well more than the typical year. So Matt, why don't you give us a little bit of color of how that volatility is actually manifesting itself across markets?
Thanks, Brad. Yeah, it's good to be here, everyone, despite the fact that this is probably the ugliest graph I've seen in a while. So this is the year-to-date performance of various asset classes through May 13th. If we start really on the left side here, we've got various fixed income categories ranging from tips to emerging market debt. In this dark blue category, you'll see that everything is down and down significantly, with core US fixed income, kind of the Bloomberg US aggregate index down about 10%. We've got high yield bonds down over 10%. We've got long duration down over 20%. Then we have international and foreign and emerging down 9.9% and over 14%. So pretty indiscriminate here within the fixed income space. If it's a bond, it's down basically, and down meaningfully. And then we get into the gray sections here, ranging from US large cap to emerging markets. Again, same story, everything down double digits, kind of ranging from 15 to 20% down. And if we put in kind of yesterday's market move, we're down north of 20% in most of these categories now. Within the light blue here represents the real asset category. So real estate also significantly negative. The one bright spot has been, with this spark in inflation that we've had, commodity sensitive assets have performed well, up almost 30% year to date. With that, if we turn to the next slide here, just a glimpsing at the yield curve, how much and how quickly this has changed since really the end of the year, end of 2021. Coming into the end of the year, the 10-year treasuries, it was 1.5%. We're now about double that at 2.9%. So when we've seen kind of the same move that we saw in the first quarter kind of continue since then. And then we have here over the 2-year period, the 2-year treasury, we see a move from 0.73 to 2.7. So an even a more significant shift on the short end of the curve. That's really a function of, the short end of the curve is more controlled by Fed and the Fed expectations around the Fed. Long-term end is more about inflation expectations. If we look down at the bottom here, we see credit spreads within both high yield and investment grade beginning to ratchet up 4.5% in the high yield bond space, coming so a meaningful shift upward in spreads, and then also even within the investment grade space, a shift up to about 1.4%. If we turn to the next slide here, this I think illustrates just I think at the beginning of the year I used what is our outlook for fixed income. I think the word atrocious was used, and I don't think any of us had this magnitude perhaps in mind at that time. And so if we look, this is really every past year, the path global bonds from January to December, every calendar year dating back to 1991. You see the dark blue line here represents 2022. So this is really a significant outlier in terms of just how significant this particular period has been relative to others. If we look here, just a quick equity market update with the significant sell-off that we saw in the beginning of the year, we've seen a pretty significant move down in valuations. So we were in the U.S. significantly above average just about five months ago. Now fairly close or approaching kind of average trailing price to earnings ratios when compared to the last 15 years. We now see international approaching one standard deviation on the inexpensive side. So going from above average to meaningfully below average. And then we have emerging markets as well, moving from about average to below average. This has been an indiscriminate sell-off for the most part within equities, with the exception of really energy and consumer staples, as you can see on the upper right-hand side. And then we look globally, we've got all the largest and most important economies listed here, just how their stock markets are performed. And so you can see pretty much across the board, significant, most of these down double digits, with the exception of UK and Canada. With that, we've got here a real asset market update. As we talked about, commodities have been the one bright spot. Within commodities, it's been energy really driving the market. The war, obviously, in Ukraine has added to that. Prior to the war, we'd seen significant increases there, but the war really added additional fuel to that fire. We get to the right side here for the real estate. It's been rather indiscriminate in terms of the sell-off, with the exception of lodging and resorts, pretty negative across the board.
We also get a question in from Mark C. asking about the returns on private equity. Mark, we didn't include those here, just trying to keep this more timely. This was through the close of Friday, but private markets have not been spared the downdraft here. Obviously, liquidity and timing and a little bit of mark to model, right? So they don't trade every day. But the joke kind of going around Silicon Valley is there's been more layoffs than there have been term sheets as of late. So they're not spared kind of the global dynamics here, but the nuances of what private equity investment, which market, et cetera, are highly dependent upon the current price of those assets. So just a general comment there across private markets. So now we know a little bit of kind of where we are and a little bit of how we got here. Let's kind of shift into the outlook gear. So as we came into 2022, we think it's important to talk a little bit about where we started the year, with the idea that that's building the foundation of kind of where we think the rest of the year could go. And we're talking about four main things that could potentially move the markets in 2022. So those were: one, kind of shifting gears from pandemic to endemic, the idea of secularly living with COVID, not a transitory event. The second is the policymaker tightrope. So that's in the Fed, but also global central banks, trying to tamp down inflation while not, do so to not completely step on growth, economic growth. The third, around inflation. So inflation, is it coming or going? Our pithy answer was yes, but we thought inflation would be persistent, but maybe not manifest in the exact same way as it did in 2021. In 2021, I think the example we used was used car sales were up 60% year over year. We thought that was somewhat anomalous, right? But that if inflation would persist, but maybe in a different manner into 2022. And so that is an important inference on what we do in markets. And then finally, volatility ahead. This was a notion that in 2021, we had a bit of the stars aligning on areas of interest and opportunity when we sit down and look at capital markets. So that would be fairly low expectations in earnings, the proverbial swinging open of the doors in markets. In 2022, we didn't really have as much of that. So we were talking about being kind of prepared for volatility ahead. So what are the things that we did in preparation moving into 2022? Well, the first is we were talking about assessing your risk posture ahead of volatility. And by the way, these are literally just screen grabs from our January conference call that Matt was talking about earlier. That's a great point in January of 2022. It's not all that helpful in May, right? If you had the opportunity to reassess volatility ahead of the market correction, that's a good time to do it. We'll talk a little bit more about this in a few minutes, but now's not the time to be rethinking the game plan. The second is around diversification. 2021 was the year of growth stocks, meme stocks, cryptocurrency. And a lot of those highly appreciated assets were things that our clients were calling in and saying, hey, I want to own more of these, or maybe just only these. And we were advising to say, you know what, we should probably keep a little gas in the tank on diversification, especially in a period of potential rising volatility. The third is around kind of getting ready to rebalance, right? Because if volatility is out there, the cousin of volatility is opportunity, right? So preparing the portfolio and having the opportunity to rebalance into that market. The fourth and fifth here were really around the fixed income market. We expected, as Matt mentioned, a hard road ahead in fixed income. We actually wrote a paper called Fixed Income Complacency, Rob Lauer and I wrote, really trying to highlight that there are embedded risks within fixed income, and the market might have fallen asleep to those, though we didn't necessarily know that it would be the worst start since the inception of the index, but just managing volatility and having an active approach. The final two here were first, maintaining exposure to emerging markets. That's as much taking an opportunity of lower valuations abroad as it is exposure to economies that have greater connection to commodity markets, which could be a tailwind with periods of inflation. And then finally was around allocation to broader real assets. Real assets being the inflation piece, broad being the shift in dynamic of inflation. So the punchline being is where we started the year is not all that different from where we think we are now. Yes, we don't have the opportunity to reassess volatility ahead of volatility because we are in volatility today. But when we think about the potential risks within fixed income, which we'll get into in a moment, and kind of how our views have shifted there, but those can still persist. The likelihood of inflation still being a meaningful driver in both Federal Reserve policy and in asset allocation prices and opportunities abroad. So, though we've materially changed prices between December of last year and May of 2022, we think largely the positions we have in place are the ones that are going to be more resilient through the year. So let's get into what has shifted. So first, let's talk about the elephant in the room. That's the Fed, right? Raising interest rates and what that's done to markets. Thus far, the Fed has made 3 rate hikes. That a rate hike is 25 basis points or 0.25%. And in markets, we can actually look at futures to see what the market is expecting the Fed to move. Now, there's no guarantee that the Fed will move in that manner, but what the markets are pricing in. Today, the markets are pricing at about a 50%, or today, meaning the 17th of May, the markets are pricing at about a 50% chance that we end 2022 with a Federal Reserve federal funds rate between 2.75% and 3%. So if predictions become reality, that means we would have 8 rate hikes ahead of us for the remainder of the year. So there's a lot of wood to chop potentially if that comes to fruition. Now, what's important to note though is there's not 8 times, there's not likely to be 8 times the amount of pain additional that we would see in fixed income, right? Because markets are predictive mechanisms. They're trying to look into the future and then figure out what that means for me today. And they know that the Fed is increasing rates. But it does mean there are inferences for potential volatility within fixed income. It means there are inferences in the economy and rising. I know we got a question on stagflation, which we can talk about in a moment. So the Fed has most of its work still ahead of us. Now, the only other thing that we would also talk about here is it's not just about the Fed funds rate, even though that's a lot of the conversation. It's also about the evil twin of quantitative easing, which is quantitative tightening. So since COVID, G7 central banks have added $8 trillion to balance sheets in open market operations where they've been purchasing bonds. 2.8 trillion of those came in 2021 alone. Now, as we shift into the opposite, quantitative tightening, we're going to be shrinking balance sheets. And you can do that 2 ways. You can either just stop buying and let the bonds mature naturally, or you can explicitly sell bonds in open market. Thus far, the preference has been to just let bonds naturally mature. What that practically means to us as investors is that with quantitative easing, the Fed was providing liquidity in the fixed income market. Now liquidity is likely to be lower. With lower liquidity could potentially mean greater volatility. So when we think about fixed income, right, a lot of the Fed's work is still ahead of us, and quantitative tightening could potentially produce greater volatility through lower liquidity, but it's not all downside here. As Matt mentioned, we started the year with atrocious forward-looking assumptions, but now where we sit, fixed income is looking a bit rosier. So this is a simple graph where it just overlays the 10-year treasury yield and the future 10-year return of the Barclays Agg. They're clearly aligned. In short, saying the best prediction of a future return in fixed income is what is the current yield. And the current yield has gone up materially within fixed income, but it hasn't gone up without risk, right? So when we talk about the opportunity within fixed income today, it is better on a forward-looking basis, but it's not riskless. The next point that we want to get through is a lot of people have the intuitive connection between rising rates and fixed income. I think some investors have been surprised between rising rates and the impact on the equity market. Well, one of the main impacts has really come through more expensive securities, namely growth securities. And the connection goes something like this. So if you're an investor and you're trying to invest in a stock, you're trying to figure out, all right, what does the company earn and what it will earn in the future? Because you're buying kind of opportunities in the future, not in the past. Well, to figure out what your best guess of earnings in the future, you have to figure out what those are worth in today's dollars. And so use a discount rate to do that. Well, as rates are rising, discount rates rise, which means future earnings are worth less to me today. Now, how that practically came to bear in the market is more expensive stocks that are reliant upon future earnings growth, not earnings that are being earned by the business today, have been much more impacted by the rise in rates than have been securities that have a lower cost. So this is quintiles or 5 buckets of price to earnings. And you can clearly see there's been a large difference between the most expensive stocks and the least expensive stocks. Now, the simplest version of this is kind of the difference in value and growth. And the graph here we have is the difference between large cap value and large cap growth here in the US. Now, they're both down year to date, but in aggregate, growth has underperformed value by almost 17%. So, there has been a pretty material impact from rising rates, positively on a future outlook on the fixed income side. But when it comes to the equity side, there is a big impact there. And rates, the source of that is from inflation. So Matt, with that, I'll turn it over to you on kind of some of our thoughts and outlook on inflation.
Thanks, Brad. So if we look here at this slide, this shows really a rolling 12-month view snapshot on inflation. So we started the most recent period here, 8.2% through the end of April. And then we see here a 6.1% on really the core CPI. You can see really that kind of a hockey stick period that really began in 2021 in terms of this acceleration in inflation that we've seen. If we take it back all the way to the early 1980s, we have to go back to 1982 when Michael Jackson released Thriller, to the last time we had inflation running at this level that we've seen, just to put that into context. So it does appear, however, if we're just looking at the very short-term snapshots that we're seeing within the TIPS break-even rates, the market is expecting, just over the past couple of weeks, there is kind of a reduction in some of those break-even inflations looking out over the next 10 years. And then we see what appears to be kind of a rollover in inflation that perhaps we are at hitting peak inflation as we speak. If we look at the next slide here, I think this is helpful to kind of point out really 3 different regimes that we faced historically. One on the left side is falling inflation. That's been kind of our regime 18% of the time, going back to 1973. And then we see here stable inflation regimes about 65% of the time. And then we see on the right side here rising inflation regimes, which have occurred about 17% of the time. So if you go to if you look at left to right, you can see in falling inflation regimes, we see stocks and bonds both do very, very well. We see commodities oftentimes do not do very well in those types of environments. And then when you look at those kind of stable inflation periods, they tend to be pretty good for stocks. they're okay for bonds and so on and so forth, and kind of a mixed bag for some of the other asset classes. The regime that we're in right now on the right side, rising inflation, 17% of the time. It's not been good for stocks or bonds. Both those categories are negative. And then we look to the right here, we see significant positive out of commodities, metals, whether it's precious metals or metal stocks, energy, and even real estate perform reasonably well in those kind of environments. So this is why when we talk about allocating to some of the real assets, we tend to focus on these real assets for periods of inflation. Most inflation that comes through at one point can't come through in the form of unanticipated. The market is very bad at anticipating inflation, and it's usually not realized that it's upon us until it's already here. So with that, I'll turn it back over to Brad.
Yeah. So with the amount of volatility that we've had in the markets, I think one of the main questions coming in from a lot of our clients is like, all right, can we have some context around this? Like, what is driving volatility, and what are the main concerns? And then how do I put that into historical context? Is this unprecedented? Is this normal? Right. So there's a couple of things that we wanted to hit on. The first is just around some of the volatility that we've seen in like single securities. So yesterday, the example was Target. So Target missed earnings and traded off, I think, 22% or so. But there are many other examples like that, where it was Meta, which is now what Facebook calls itself, or Netflix. And so as we think about some of these individual events, right, there's always going to be idiosyncratic or single security risk. But I think it speaks to a bigger and broader theme across markets, and one of the things that's driving volatility. So if you break down the return of a single security, or in this instance, this is the S&P 500, you can break it into two components. One is the price that you're willing, or the what you're willing to pay for it. That's the multiple. It's the green line here. And then what the business earns. The combination of those two is what the price ultimately is. Now, we can see during COVID, multiples rose materially. Effectively, that was the world saying, I don't know how and when we're going to get through COVID, but the sun will rise another day. So we're betting on the future. Since then, it's been largely flat or drifting down. And part of that is, one, multiples were already expensive, but two, with the Fed increasing interest rates, it's less likely that the multiples would move materially higher. So the earnings has really been the focus for the market. So as earnings have continued, there's been a large expansion in earnings, and that has helped drive the market and kind of push the market in 2021. As we come into 2022, we have a harder market of which to continue to meet those expectations. So if we look back just at Q1 of 2022, 91% of companies have reported earnings in the S&P 500. 77% of them have reported positive earnings surprises. So that's a good thing. Now, as we break down kind of those positive earnings surprises, the rate at which they're beating has fallen. So that's slowing. And then as we look at revenue beats and revenue growth, if we look at profit margin, if we look at earnings, those have also been slowing. So today, as we look forward, analysts across the market is expecting for calendar year 2022 for earnings to grow at 10.1%. That's a pretty hefty growth rate, given kind of our current economic backdrop and things going on in the market. That sets us up for potential disappointment. And that's where you get some of these single security events where they trade off very material in a single day. Now, again, that doesn't mean that the market will necessarily move down on that, but it could. It just means that we think at the very least it's going to create additional volatility in the short term. Now, it's not just about earnings. Earnings are important, but also it's about kind of the R word that's been coming up, which is recession, right? So we can even see recession showing up in Google Trends, and it's a much more common conversation. This gets back to the Fed and what it's doing, have potential of 8 or rate increases in 2022. That's a far less accommodative environment than we've been in the past. We have slowing economic growth, both here in the US and globally. And we've obviously had a war breakout in Europe. And so with economic conditions slowing and fiscal policy being fairly stagnant and monetary policy somewhat moving against us with higher rates and quantitative tightening, that has increased the probability of recession. Now, we do not forecast for a recession, right? We build portfolios that have recessions in mind. We have markets that have recessions and corrections and bull markets. And so we want to build through that resiliency, not try to predict in time that resiliency. But nonetheless, the probability of recession is rising. And so that has put more volatility into the market. So with that in mind, we think it makes a little sense to break down some of the differences between the garden variety type volatility and the recession volatility that you might see in portfolios, and really how often those occur.
Yeah, since 1950, there have been 20 drawdowns of 10% or more. The most common by far are drawdowns between 10 and 20%. They occur on average about every 3 years. So if you look at the table below, you can see that about the average drawdown that's greater than 10 and less than 20 comes in around a 14% decline. On average, it took the decline lasted 7 months. Then we look at the traditional bear market definition, greater than 20%. So we call this the mere typical bear market, down 20 to 40%. Those occur about every 14 years. The average drawdown there is right in the middle at 30%. And then the average length of that is about 9 months. And then we have what we might call the super bear markets. Those occur kind of on average about greater than a 40% drawdown. They occur about every 23 years. And the average drawdown there is 51. So we're looking at things like 2008, 1999, 1973, 74, so on and so forth. The average length of those bear markets is 23 years. If we look here at the next slide, if we just look at the frequency of pullbacks that are 10% or more, most of them become mere corrections. 73% become corrections. 27% dip into the bear market category. The correction is nearly 3 times more frequent than a bear market. And then we look at the recession probability. With a mere correction, there's a very low probability of recession. Only 9% of those have turned into or accompanied a recession. 88% of the time when we've had a bear market, we've also had a recession. And then we look here at the length and time. Obviously, it's longer when we've had the length and days of the drawdown. And then we look there at the far right, correction. How big are they? The magnitude. The bear markets that we've had have had about, on average about a 38% decline, peak to trough. The next slide here illustrates really the dangers of trying to time the market. And this is a popular chart. It seems to come out every time there's a correction or a bear market, because the one thing to remember is, missing these wrong days or missing the wrong days in the market is extremely costly. And so, for example, just omitting the 5 best days since 1980 has would have cost your portfolio 43% total cumulative. So that's 5 days out of over 40 years. If you miss those 5 days, it had significant impact. Why is that important? Well, it's because those particular 5 days tend to come along when the market is most volatile. So oftentimes when it's scaring the pants off of investors, when investors are more likely to make rash decisions and pull out of the market. And then you can see here missing the best 10 days, the best 30 days, and missing the best 50 days. I mean, that's only 50 days out of a 40+ year period. That's not a lot of days, and essentially would result in a 97% reduction in return. So this is really why it's there's significant risk being out of the market at the wrong time, why market timing is so dangerous. And then we look here, just a nice chart that lays out the historical pattern going back to 1949, where bull markets have been the norm, and then we sprinkle in various bear markets throughout there. So the average bull market, we've had a 263% return. They've lasted 71 months. And then the average bear market is about a 33% decline and has averaged about 14 months. With that, I'll turn it back over to Brad to talk a little bit more about our outlook.
Yeah, so in conclusion, we've got a decent amount of questions in the queue, which we can power through, but we'll wrap up, kind of some of our first thoughts here. So first is, look, going forward, there could be continued potential for a rocky road ahead, right? There could be more volatility in the market. And that's based off of a lot of comments we made, right? The likelihood of recession is rising. The Fed is being less accommodative. The reliance on earnings continuing to beat. Those create volatility. Now, volatility in and of itself is not necessarily evil. Doesn't mean that there's a super bear market ahead, but that we should prepare and set our expectations around that to be, very much possible. And in the same vein, fixed income, while the outlook is improving, it's not without risks, right? Most of the wood to chop for the Fed is still in front of us. With quantitative tightening, we have less liquidity in that market. And so, that's an area where, as our capital market team meets every month, and as we talk about updating our capital market assumptions, so our forward-looking predictions, if opportunities and the facts change, our opinions can change. That's an area that we're watching very closely to see if, fixed income becomes interesting enough that it could necessitate a change in portfolios, a change in outlook, and potentially a rebalance. So it's not something we're calling for today, but it's an area that we've been watching very closely. On the inflation side, we very well could have peaked with inflation in March. That's possible. But inflation is not going anywhere in any time soon. Even at 8.2 with the Fed's preferred inflation rate at 2, there's a lot of space between those two. And the stickier parts of inflation derived from wages or housing, those are areas that are going to be harder to overturn on inflation. So we do think allocating and continuing to allocate to areas of the market that can help guard against the erosion of return from inflation over time will continue to be important. This gets back to at the beginning of the year saying, hey, now's the time that if you want to reassess your risk, do it now. Don't do it in the middle of the game. Now we're saying the opposite. We're saying we're in the middle of the game now. This is where it's costly to make big decisions, to make emotional decisions. Matt had that chart up, the 5 best days of 10,000 trading days. That could be a very costly mistake. So now's not the time to change the game plan. Now's the time to have, kind of persistence and faith in the plan, which gets us to, our last point here on kind of patience and diversification and remaining resilient. It's worth bearing in mind when we build portfolios, we're building them with recession in mind, with drawdowns in mind, with bear markets and corrections, et cetera. That's a natural functioning part of the market. So managing through those is kind of key to making sure you don't erode long-term return. So why don't we jump to some of the questions? And Matt, I'll throw the first one out to you. How does the end of the bull market in bonds affect strategic allocations?
Well, I think, having a bull market in bonds is great at that particular moment, but then there becomes, when you have these rising interest rates like we've had, when we started the year, the Bloomberg US Aggregate Index was at 1.7% yield to worst. Now it's, as of the end of April, it's over 3.5%. And so when we look at that on a go-forward basis, bonds went from having about a negative 1% real return expectation to having north of or close to a 50 basis point plus positive real return expectation. So in the short term, having seen these big interest rates spikes that we've seen are painful for bondholders, but in the long term, it's the best thing in the world that can happen to bonds, because now you'll start compounding capital at a higher rate of return. So I think the end of the bull market, we had a pretty explosive end to the bull market here in the first few months. If anything, it's painful, it's ugly. We don't like it if you're a bond owner, but going forward, it certainly makes that asset class appear much more attractive.
So we also, Matt, I'll throw this one to you as well. Changes in capital market assumptions and recent volatility. Are there expectations there? I know I alluded to some of that, but maybe a little bit of color on normal process and where we sit.
Yes, we internally run our capital market assumptions on a monthly basis. We wait for them to stabilize a little bit, and we wait for meaningful changes before rolling them out. Our expectation right now is we're going to be looking at them at the end of May and at the end of June, and it's very likely we're going to be putting out additional capital market assumptions. For example, I referenced that U.S. fixed income Our return expectation went from about 1.7 to would have gone to 3.5. We're going to continue to take a look at that, and when the time is right, bring out some new capital market assumptions, because we also expect to see rather significant shifts, not only in fixed income expectations, but also within equities, as we've seen a 20% sell-off broadly in equities. That's going to mean we have a meaningfully higher return going forward. So look for all, be on the lookout for that over the next couple of months.
So we also got another question in on the high yield market. What do we think of the high yield market today? And I can take that one. As we look at what has happened in fixed income, a lot of the change in price has come from interest rate exposure, while spreads, meaning the yield, has come up a bit. Most of the price change can be described from interest rate or duration risk rather than change in fundamentals on spread. So we had that chart where we show IG spread, investment grade spread, and high yield spreads widening, but they're still not incredibly wide, right? So it hasn't prevented, or it hasn't produced an environment where you say, wow, high yield's very attractive here. I'd like to jump in, where you've seen in other past market pullbacks, when you see equities kind of down at this level, spreads on fixed income, especially non-investment grade spreads, tend to widen out a bit. So it's an area that we're watching, but it hasn't really manifested in a material way for a very attractive opportunity in the short term. But to Matt's point on our process for updating CMAs, that's something we're consistently looking at and making sure that if that does change, right, if the facts change, our opinions change, then we could look to that space and see what opportunity it could provide on a forward-looking basis.
Yeah. Brad, I think I'll take the next one here, which is on crypto. Why has crypto declined dramatically when it was touted as an alternative asset? Is gold a better alternative asset class? When it comes to crypto, I mean, we would describe that as a highly speculative asset. And when you have a massive sell-off like this, it's not extremely surprising to us that asset sells off. And it's an asset that doesn't really have a strong underpinning for intrinsic value associated with it. And so when it falls, there's really not a lot to create a floor underneath it. And so hence its volatility. I think as we continue to look forward here, thoughts on stagflation was another question that came up. And I think, from one technical perspective, we're almost at stagflation. Just to quickly explain that for folks who might not know that term, stagflation is the presence of both inflation and either slow economic growth or recession simultaneously. Typically, those, at least since the 1970s, have not occurred, or early 1980s, have not occurred together that often. But we're in a period now where we looked at the first quarter, for example, this year, we had highly elevated inflation, but we also had a negative GDP growth. Most of that negative GDP growth that we saw in the first quarter basically came from a replenishment of inventories and a kind of an uptick in imports. So in the first quarter, it was technically a negative number, but on a lot of other metrics, the economy still looked reasonably healthy. But yes, there is, I think, meaningful risk of stagflation to continue. And that's what the Fed right now is trying to do, a magic act to try to avoid, because the Fed wants to raise interest rates to slow down inflation, but they don't want to cause a recession. They want to have their cake and eat it too in that regard. And that's going to be because they got caught a little bit behind the curve on raising rates. There could be this period of overlapping high inflation and slow to negative economic growth. So I think that is very much a concern for at least the near-term future.
We got another question on Reits, as we were talking about the inflationary environment. So why is it that as inflation has been rising, Reits haven't responded in the same way? I would answer that a couple of ways. Reits as a category, is a very broad basket of underlying real estate investments. Some of those investments have a little bit more duration, if you will, or interest rate sensitivity. As interest rates are rising, they could sell off. So you think of the stark example of commercial real estate, where you have a lease for a minimum of 5 years, maybe up to 10 years, versus a hotel room where you reprice, basically every single day. The benefit, from rising rates and potentially rising prices and through inflation can be immediately felt in a hotel, where it would be felt over a longer period of time from a commercial real estate property. So over time, those assets, they do tend to rise in value. If you think about inflation as the cost of increasing goods, those physical assets, whether it be commercial real estate or a hotel, if you were trying to build another one, it's more expensive to do it today. So the value of the building already in the ground is worth more today, but the sensitivity in the short term tends to be very different across REITs. And that's why you saw that dispersion in return. So over longer periods of time, you would expect to see real assets like real estate and some of its subcomponents to perform fairly well with inflation, but maybe not just at every asset and at the right inflection.
Okay. Another question that popped up here. What do you think about investing cash in stocks? That's a question that came up. And right now we're in the midst of a bear market, which if you're putting cash into stocks, you'd rather be doing it now than you would, say, at the beginning of the year. I'll just state the obvious. But I think when it comes to putting cash into stocks, first of all, look at your objectives. What are you trying to accomplish? What's your time horizon? All of those sorts of things. But at the same point, when if you are making an entry point, you do have a reasonable forward-looking time horizon. To kind of throw everything into stocks all at once is typically a bad move. So we would always suggest doing a dollar cost averaging approach, that and rather than just trying to time the market and betting on it one particular day in the market, it's better to kind of gradually drip in over time.
Yeah, and our final question is around rebalancing. Just given the volatility of markets today and the dispersion between fixed income and equity, are we recommending rebalancing? Rebalancing, it's a little bit client specific, right? Depending on their current allocation and objectives and when they would hit those. We would say that in general, you should probably be looking at rebalancing, given the level of volatility seen. Now, what has been atypical in this cycle versus usual corrections is usually as stocks go down in a material way, bonds have gone up in a material way historically. Today, we've seen the opposite, given the fact that the volatility has come from rising rates. Fixed income has fallen quite a bit and equity has fallen a little bit more. So it may not be your typical reallocation of that of which has done well to that of which has done poorly, which is the benefit of reallocation over time. But now is a time to start to look and say, okay, are there opportunities to which we should reallocate? And that could be stock to bond. It could be value to growth. There could be a lot of different ways in which you can look at reallocations. But given volatility, we do think, again, getting back to what we said in the beginning of the year, ready your rebalancing playbook, like be prepared, for potential opportunity here to rebalance. So I think we've gotten through most of the questions. I certainly know we've gone over time. So we appreciate many of you sticking around with us. We promised we'd stay around for questions, and so we did. So we borrowed an extra 15 minutes of your time. But thank you for joining. We very much appreciate it. This will be recorded if you had to duck out or if you missed it, or if you want to share it with a colleague or a friend or anyone else. We appreciate you dialing in. And then if there's any questions we didn't get to or things that you want addressed separately, please feel free to reach out. We're happy to discuss individually. But thanks so much, everyone, and have a great rest of the week.